Let's face it, size matters.
Truly epic proportions.
Especially when it comes to your financial talk.
I have a plan.
Quick sound bites and rush chatter won't help you.
Blah, 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 blah.
You want more details, more depth.
Concentrate. Focus power.
More to think about.
What do you think?
This is MoneyLife's Big Interview.
I think it's brilliant.
A meaningful conversation on money and markets.
This is why we're here.
So settle in.
I made you coffee.
You're going to be here a while.
That's just perfect.
Welcome to the Big Interview here on Money Life, and I'm pleased to be joined right now by James Rickards. He's the author of The New Case for Gold. Now, if his name rings a bell, it's because he wrote two best-selling books, one, Currency Wars, and the other, The Death of Money. We have been talking a little bit about gold on this show. We sort of got back into it because a number of you were asking for me to go there. Well, James's book is out officially tomorrow. That's when you're going to be able to find it for sale in stores, not just for pre-sale. But if you want more information, go to jamesrickardsproject.com. He's on Twitter at James G. Rickards, and it's all linked up at the Money Life Show recent and upcoming guest page. James Rickards, welcome to Money Life.
Thank you. Great to be with you.
The New Case for Gold starts off in a place where we're looking at how the old case for gold has left investors, or at least average investors, kind of dissatisfied. You know, we went from the era where you always had a reason to keep gold in your portfolio and the rule of thumb was 5 or 10%. Then that kind of got beaten out of investors because that was the worst 5 or 10% and they hated it. Then, of course, as soon as it was beaten out of them, gold had a strong rally and it became something that people wanted to do again. And then, yeah, it sort of repeated itself, not so much. So why this time should people be looking at gold, and why should they be taking a different look than normal?
Well, you know, Chuck, there's more to owning gold and having gold in your portfolio than just day-to-day price fluctuations. Now, look, from August 2011 to November 2015, that's over a 4-year period, gold went down about 45% from about $1,900 an ounce to $1,050 an ounce. That's not a lot of fun if you bought it at $1,900. But gold is the best performing asset so far this year in 2016. But more to the point, it's also the best performing asset class of the 21st century. You go back to 2000 out to 2016, gold greatly outperformed stocks and bonds. Now, look, anybody can cherry pick start dates and end dates. Some stock fan will say, oh, well, look at March 2009, the stock market more than doubled, which is true. So that's a little bit of a game. But my point is, don't worry too much about the day-to-day fluctuations in the dollar value of gold. Think of gold as a couple things. Number one, it's insurance for your portfolio. So I recommend 10% of investable assets in physical gold. Not 20%, not 50%, not 100% by any means. 10%. If nothing happens to the gold, if it's kind of flat, no one's going to get hurt by that. You'll do fine on your other 90%. But if the other 90% burns down, if we have a stock market crash, which I expect, and something like 2008, but worse, which I also expect, and we can get into that, gold is the thing that's going to stand up and preserve wealth. In addition to those normal portfolio considerations, so stocks, bonds, gold, they're all just alternatives for your portfolio, there's a new threat. The reason I call my book The New Case for Gold is because there are reasons to own gold that are just emerged in the last couple of years, which is cyber financial warfare. Vladimir Putin has a 6,000-member cyber brigade. These are not criminals. These are Russian military intelligence officers working day and night to hack, delete, destroy, and disrupt every stock exchange, every bank in the world. So if you have, a lot of people say, I have wealth. I say, really, what do you mean? They say, oh, I have stocks and bonds. I say, no, you don't. You don't have wealth. You have electrons. That is all vulnerable to being erased. Whereas if you have physical gold, can't be hacked, can't be erased. That was not something that we talked about in the 70s, 80s, 90s, or even the early 21st century. That's a new reason to have gold. So,
but let me step.
That's your insurance.
But let me step in for just a second. That means that when you're talking about somebody owning physical gold, you are talking about holding the precious metal yourself or paying for storage for it. You are not even talking about saying, let's go get a physical gold exchange traded fund, because if you're buying the exchange traded fund, you still have electrons, don't you?
Well, that's correct. And actually worse than that, yes, you have electrons that can be wiped out and deleted. So that's the reason to have physical gold. But even if that didn't happen, by the way, it's happening. You know, last week it was reported that the country of Bangladesh, one of the poorest countries in the world, $100 million of their money disappeared. Now, you know where they had that money? That money was on deposit at the Federal Reserve Bank of New York. It wasn't in some, rinky-dink Bangladesh bank. The country had $100 million on deposit at the Federal Reserve Bank of New York, and the money disappeared. So when I talk about these things, this isn't science fiction. These things are happening. But coming back to your point, Chuck, yeah, even if it's not a race, here's what's going to happen. When do you most want your gold? When do you most want your gold? You most want your gold when everything else is melting down. There's a financial panic, worse than 2008. You know what's going to happen to ETFs? They're going to suspend redemptions. Same thing with unallocated gold contracts, gold futures. All of these futures exchanges and stock exchanges have provisions, if you read the fine print, that allow them to basically cash you out at yesterday's price. They won't steal your money. They'll send you a check for yesterday's price, but you're going to be sitting there saying, hey, it's up $100 an ounce today or $200 an ounce tomorrow. Where's my profit? And they'll say, sorry, you're out because there's a physical gold shortage. You can't get the gold. So you're going to get cashed out at yesterday's price, and you're going to miss out on the future appreciation. That's the way these paper gold contracts work. I don't even consider them gold. So, yes, you want physical gold in non-bank storage. Don't put it in the bank safe deposit box. That's the first place the government will go to lock it down. But there is non-bank storage available from reputable firms. I don't want to recommend any, but to people like Brinks, Loomis, Dunbar, Brinks has been around for 100 years. They're insured. They're reputable. There are places to put your gold that are safe that's outside the banking system.
When we talk about somebody maintaining a 10% asset allocation in physical gold, are they literally saying I'm rebalancing on a fairly regular basis? Because under the circumstances you talked about, market tanks, gold holds its value, et cetera, you can see 10% become 15 or 20 pretty quick.
Sure. Look, if your gold allocation 10% is going up to 15 and 20 because everything else is melting down, you probably want to hold on to your gold. That's the reason you bought it in the first place. So it's kind of 10% in the steady state, but let it roll, let it go up if stock market's crashing. And Chuck, when I talk about these things, again, people kind of roll their eyes and go, "That'll never happen." Well, of course it happens. People lost 50% of their wealth in 2008. Go back to 1998. Long-term capital management. By the way, I was the general counsel of long-term capital management. I negotiated that bailout. I was on the phone with the Treasury and the Fed and the heads of the 14 largest banks in the world. I know that markets were hours away from every market in the world shutting down. It didn't happen because we got the deal done, but if we hadn't and we were hours away, beginning in Tokyo and going around the world, every stock and bond exchange in the world would have shut down. That's how close we came. Same thing in 2008. We were days, if not hours, away from the sequential collapse of every bank in the world, but they were bailed out by the central bank. So how many close calls do you want to have? How many times do you want to come close to a total meltdown before it actually gets out of control and happens? So get your gold now, because when the panic hits, you're not going to be able to get it.
Let's talk about the panic hitting, because obviously you are expecting some bad stuff to happen. Explain why, and why gold is still going to be something that you want beyond the electrons and holding the physical gold side of it. Traditionally, gold, of course, a hedge for inflation. As much as I've got lots of people coming on saying, hey, the market's going to go to hell in a handcart pretty soon here, I don't see anybody who's saying, and the resulting problem is going to be massive inflation. So, of course, we're making a new case for gold. Make it in the context of why you see the market going to the tank.
Well, I don't use speculation. I use science. And by the way, my models are completely different from what central banks use. They're using obsolete stochastic general equilibrium models. It's kind of like a thermostat. Your house is too cold, you dial it up. The house is too warm, you dial it down. That's an equilibrium, a linear equilibrium model. That's not how capital markets work. They work in accordance with complex dynamics, which is a branch of physics, and that's what I use. So a couple of things we learned from complexity theory. Number one, the worst thing that can happen is an exponential function of the size of the system. That means if you double or triple the system, you don't double or triple the risk. You increase it by a factor of 10 or 50 or 100, depending on the inputs. So let's go back to 2008. What was the problem? Banks, what did we hear? Too big to fail, too big to fail, too big to fail. Well, guess what? Since 2008, the 5 largest banks in the United States are larger than they were in 2008. They have a larger percentage of all the banking assets. Their derivatives books are much larger. In other words, everything that was too big to fail in 2008 is bigger today, and the risk is exponentially greater. But here's the difference. In 2008, the Fed's balance sheet was $800 billion. They could take it to $4 trillion. They could print $3.2 trillion of new money to bail out the system. The problem is they're still at $4 trillion. They've never normalized that balance sheet. So what are they going to do in the next panic? Take it to $8 trillion, $12 trillion? I mean, what is the outer boundary of confidence? And that's the point. They don't have any dry powder. I say they. It's not just the Federal Reserve. The People's Bank of China printed more money than the Fed. Same thing over at the ECB, the Bank of Japan, the Bank of England. All those balance sheets are bloated. None of them have been normalized. When the next panic comes, it'll be bigger than the last one for the reason I just mentioned, and the central banks are out of ammunition. So the only clean balance sheet left in the world, the only institution that can print a lot of money, is the International Monetary Fund. They print this world money called the Special Drawing Right, or the SDR. When they do that, there's your inflation. They'll print trillions of SDRs. No one will know where the inflation comes from because no one understands. Very few people understand SDRs. But you don't have to understand SDRs. You just have to have the gold, and that'll protect you.
For somebody who has not been in gold, who perhaps reads the book and says, okay, I can make sense of this, where are you suggesting their asset allocation for gold come from? Does it come from the equity portion, the fixed-in portion, or the cash portion?
It just comes from the portfolio, 10% of your portfolio. By the way, I would have a large slug of cash. I personally don't own any publicly traded equities because I don't want to lose 30% of my wealth in a matter of weeks, which is coming. So, but yeah, that's a personal choice. If you want equities, that's fine. I'm recommending 10% gold. That gives you 90% to do whatever you want. So I have cash, fine art, land, private equity, some technology startups. That's my portfolio. But if people want to buy regular stocks and bonds, but I think 10-year Treasury notes are a good investment. But if you want to do that, that's fine. But make sure you have 10% gold. That's your fire insurance. You don't want your house to burn down. But if it does, you'll be glad you have the insurance.
It's The New Case for Gold from James Rickards, author of The Death of Money, his new book out tomorrow. James, thanks so much for joining me on Money Life.
Thank you.
Again, if you want to learn more about the book, go to jamesrickardsproject.com. He's on Twitter at James G. Rickards. We just hit the halfway pole on today's show. Up next, we're heading for trouble. It's the Danger Zone. David Traynor from New Constructs in the house when Money Life continues right after this message.